Hello everybody, I hope you can hear me loud and clear. My first webinar for FX Street. So we're going to start. My idea is as follows. First of all, we're going to look at the theory of the clouds and how you design them and how you can plot them if you would like to do so. Then I'm going to stop for brief questions to make sure that you've all understood what the theory is about, and then I've prepared a whole stack of different markets that I thought you might be interested in with live prices, courtesy of Thomson Reuters, with live prices, and we're going to analyze together, using the cloud theory, how these work. Okay? So far so good? Let's kick off. Right, well, just to let you know, 16 years ago, I was employed for the first time as the first full-time technical analyst at a large Japanese bank. It was in the Treasury with the foreign exchange, interest rates. I mean, I was very, very confident because by then I had bags of experience in Treasuries around London. And imagine my horror when I saw that, first of all, half of the dealers were Japanese and spoke very little English, and the other half were looking at charts like this one, which I'd never ever seen before. I mean, quite frankly, it looked just like a messy plate of spaghetti. And I was supposed to be the full-time one that knew all about charting, and I thought, oh no. Anyway, so little by little, the busiest trader, as is always the case, took me in hand and started teaching me how to use these charts. I've used them ever since because I find them very useful, and they do bring a different element to the analysis that I do. The talk today is based on a unit which I have designed for the Society of Technical Analysts diploma course, which is taught at the London School of Economics. Now let's see. Flipping on to my next. Hopefully I'm going to, oops, there we go. Right, and this is the introduction to the cloud charts, and here we've got the Chinese characters, the Kanji. These first two mean Ichimoku. Okay, these first two. This is one, the number one, and this is at a glance. It's a sort of eyeball here. These one here, these two here mean Kinko, which is balance from a mountain. That's what that one means. And the final one is chart, which is also the word for footprint. That little picture there means a footprint. And so generally what it roughly translates as is a balanced instant view as taken from a mountain. That's what it means. And the guy who invented this is a chap called Goichi Hosoda, whose pseudonym is Sanjin Ichimoku. And he devised this system in the 1960s based on the Tokyo Stock Exchange share prices, and it was based on trial and error, laborious backtesting, and let's not forget we didn't have computers in those days. He took on these trainees, not interns but trainees, and swore them to secrecy. And the whole thing sort of went quiet for a while, but then in 1995 Hidenori Sasaki wrote a book about the subject, and that really boosted its popularity in Japan. Of course, I have the book, of course, and my kind Japanese colleagues, little by little, helped me work my way through the book, and it is today one of the most popular technical analysis books in Japan. Right, what are we going to do? The first thing to do, just to let you know, I'm going to plough my way through the system so that you can learn it, and then I will stop and I'll take questions later, please. All right? Questions will be later. So the first thing to do is plot the daily candlesticks on the chart. I'm assuming you're all au fait with candlesticks. If not, may I suggest you go to the expert on the subject, which is Steve Nyson. With these candlesticks, you're looking for conventional Western patterns, like, for example, a triangle that we've got there, or a little rectangle consolidation as there, or a potential double top as there. But you're also looking at the candles themselves, which have their own special patterns, like that one there. Okay, that one there is a little doji. All right. This one here is a big Marubozu. And here again, you've got a little doji and a greystone doji. Do learn about these. They're very, very useful. Okay. Also, just to let you know, the trading of commodities and futures is nothing new. These candlesticks were started by a trader on the Osaka Rice Exchange in the 1700s. He was very, very successful trader. He invented the candlesticks in the 1700s in Osaka. And let's not forget that we were trading in Amsterdam options on tulip bulbs in the 1600s, and we have been trading agricultural commodities in Chicago since the 1970s. So, you know, trading and using charts for this is not new. It is not a new science. What we then add to the candles are two moving averages. These were devised with, as I say, back testing, quite frankly, just trial and error. And it was found that the best ones to use on a daily chart were the 9-day moving average, which is this pink one, which most closely hugs price action, and then the 26-day moving average. The reason I think the 26-day moving average is particularly good is that in Tokyo they used to work Saturday mornings on the stock exchange, and so the average month has 26 working days in it. The moving averages are a crossover system. It is a trending system. You are always in the market, always, always, always. When the 9-day is above the 26-day, you are long. When it drops below it, you are short, and you are long, and it looks as if they're about to cross over here again. In other words, you've always got a position. But because it's based on moving averages, it does not work at all in sideways markets. You will be guaranteed to lose money if the market is not trending. So Ichimoku Cloud charts are to be used only in trending markets. How you decide whether a market is trending or not, I leave that up to you. All sorts of people have different ways of scaling in and scaling out of positions. I urge you to think about these. Okay? So there we are. I think that's pretty simple so far. Now this is where it really gets interesting, and this bit here is the cloud. This particular system has it pink when it is going up and turquoise when it is going down. It doesn't actually matter. But first of all, how to calculate this upper line? This upper line is the 9 and the 26-day moving average that we saw on the previous slide, added together and divided by 2, and plotted 26 days ahead of time. Okay? So based on the two moving averages that you see, right, which come in at 104.19 and 104.01, okay? These are added up and divided by 2, and they come in at just above 104. In fact, 104.10 to be precise. It's over there. Can you see? Can you see that over there? That's that sort of rusty brown line at the top. So that is that, those two, average of those two, plotted 26 days ahead. Again, 26. Remember that. Keep that in mind. Okay. Now the lower line of the cloud, called span B, that's span A or line A, that's span B. It's completely different. It's completely different. Its calculation is as follows. You look for the highest price of the last 52 days. In other words, as at here, go back in time and find the highest price of the last 52 days, which will obviously be that one there. And then to that you add the lowest price of the last 52 days, which will probably be that one there. You add those two together and divide by 2. And that comes in here at 101.40. 101.40 is the average price. And because often a low stays there for a very, very, very long time, and a high remains in place for a very, very long time, what you'll tend to see with this line is that it goes flat for ages. And here it is over here, flat for ages. And again here, flat for ages. And continues flat for a very, very long time. Can you see that? In other words, you've got an absolute outlier of a high and an outlier of a low, and those dominate for days and days and days until eventually they drop out. Okay? Now, what this is just like the moving averages are suggesting a long or a short position, depending on how they lie, so too the cloud, if it is rising, suggests a long position, particularly so if the candles are above the cloud. So this is giving you more layers and levels to consider, not only as to whether you should be long or short at all, right, but where your support and resistance levels will lie for today's trading. Okay, so here I think you'll agree that the averages, while they have been keeping you long all the way through from this point, might be beginning to cross, and you might begin to reconsider whether you still want to be long. Looking at the cloud, however, that is resolutely bullish, and you'd say, well, actually, no, my cloud still suggests I should stay long. Maybe, seeing as I've got mixed messages, I should stand back and see how it pans out. And certainly that would have been the case here, yeah, where your averages were long and yet you were trading under the cloud, yeah, suggesting you should be short. So possibly at this point here you would have stood to one side and see how it worked out, and then 2 days later they were all aligned for a bullish position. The moving average themselves provide support and resistance to today's price action. So you'll see that that green line is providing support today. Okay. Meanwhile, that red line also provided support on that day, but resistance here and again here. Okay. Same for the 26-day moving average. It did provide resistance over here, and it provided support on that day there. Can you see how it captures that daily low? Caught it and pushed it higher. Very determined. Likewise, the top of the cloud will provide support for today. So that comes in here at 101, just above 101 the figure. And then again, way, way down, that is your last line of support for the current price action, coming in at 9,750. Okay? So those are 1, 2, 3, 4 levels of support and resistance as provided by the elements of the cloud chart. And now to my final and rather trickier line, and this is very unusual. It's this green one here. It's called the lagging line. It is a line chart of the closing price plotted 26 days ago. So it is this closing price plotted 26 days ago. That closing price plotted 26 days ago, right? That closing price plotted 26 days ago. And what does this line do? Well, again, this line, it'll give you an idea of where, looking down at the candles, at the moving averages, and at the cloud, where support and resistance for today's price action might lie. So as well as looking down here, that would be your first level of support, your second level of support, your third levels of support, and your fourth level of support based on this setup here today. This one will give you more levels. So the candles themselves become support. Notice here how that supported the move, the rally from that point there. Here it tried to just missed it, but then they caught up. Yeah. So here, today's price action will get support from that candlestick, the top of it, that candlestick, its lower edge, that moving average, that cloud, and that one there will be your final, your fifth and final level of support from this line here and its associated averages and clouds. Okay, so you've got a lot of different levels that you will be working with. The whole system was designed for daily clouds, but I tend to find that it is excellent on weekly ones, and I'll show you a couple of weekly charts now. This is the Nikkei 225, and you can see that here it did try to provide support. You go into the cloud, that one is still providing support, allowing you to bounce above the top of it. When we come down again, the lower edge of the cloud, day after day after day, does just about provide support. We break below it but close on it. Once again, we're clinging to the bottom of this cloud, and eventually we break above the moving average, which now provides support. It's trying to push you higher, and eventually you break above the two moving averages, which now cross to a long position. Here again, you go through the thinnest bit of the cloud. That is where it is easiest to break through the cloud, of course. Yeah? It is easiest to break through the cloud when it is at its thinnest. And now we broke above it, and now the cloud is providing support. 9-day moving average is currently providing support on a weekly basis. That would be your next level of support, then that one. Okay. Notice also here that the lagging weekly line got support from that 26-week moving average here and here again. Okay. It also got support from the 9-day moving average and the top of that candle. Okay. So the distance between the candles and the clouds are not important. Okay, it's not like an RSI when you just got two beyond or anything like that, overbought, oversold, whatever. That is not the case. The only thing that matters is if the cloud is very thin, it's much, much easier to see a turn in the trend. If the cloud is fat, it's far more likely to provide the support that you might expect in a trending market. Okay. Another chart here, a weekly chart. This is the Dow Jones Industrial Average, going back to that March 2009 low, where you can see that eventually we started holding above the 9-day moving average, got support. The 26-week moving average provided resistance for a few weeks. Then it starts providing support. The two of them cross to a long position, and you do manage to push up towards the lower edge of the cloud, which provides resistance initially. Then you work slowly through a very, very large descending cloud, garnering support from the 9-week moving average here. Again here, while the candles hold just above the cloud. All aspects here are well and truly long, keeping you long all the way through. Slight glitch with the averages here in 2010, but they do manage to push you up. The cloud managed to push you up again. Again, all aspects here continuing, suggesting a long position onwards and upwards, marching higher, all aspects. And notice here how the lagging one was clinging to those clouds for dear life, trying to get support, and it did manage to do so, getting support here from the moving average and here from that moving average. Gathering onwards and upwards we go. My final chart here are just a reminder, and I forgot to mention, the Japanese moving average is not calculated by the closing price. It is calculated by the average of the high of the low of that day, which some feel is a far more equally weighted central point, which is a more natural level from which to work with. This is the first part of my presentation, and I just wanted to let you know that here we have launched Technical and Analyst TV channel. It's called Forex Trading TV, and I'm the chief technical guru, whatever you want to call me. We work in a live environment where we watch about 150 charts on all sorts of different currency pairs. As FX Street knows, I've been looking at currencies for the best part of 30 years, posting my views, news and ideas on FX Street for many, many years. Here we're doing this for you, we're alerting you to what's happening in real time. We produce about 25 to 30 video alerts per day in 3 different styles. I tend to do the long-term overview, while my colleagues Leith and Alex are much more into short-term intraday trading opportunities, identifying technical levels and targets based on their own favourite types of analysis. I do urge you all to stick to what suits you. Your analysis will always be best if you find the sort of indicators that suit you and work again and again with them, learning how they'll help you. We also provide news headlines that could move the market and cover the major economic news and show you from a technical perspective how live price action can be. Soon you will be able to download our mobile app and view the alerts as soon as they are published, as well as receive our news in real time. Do feel free to browse our site, and you can try the service for 3 days for free. Basically, the idea is we're trying to make life a bit easier for you all and ease up on some of your workload. Now I'm here at your disposal for questions just on the theory, please. I don't want to cover live markets. If you have any seriously urgent questions on the theory, I am happy to answer this now. If not, I have prepared for you a whole set of super interesting charts which you might well be more interested in looking through than the theory part of the game. Let's have a look. Right, the lagging... Hello, John Savage. No, because I started well before I started on the charts, my first choice is always the price pattern itself, particularly the candlesticks. Now I've started using those exclusively. Before I used to use bar charts, now it's candlesticks, patterns on the candlesticks and the patterns themselves, right? So triangles, rectangles, head and shoulders, classic Dow theory. That is my first choice. My second choice now, my second indicator of choice are the clouds. The website for the free day trial is forextrading.tv. I think you can see it up there. Can you just, I've just tried to highlight it for you. We're just going to highlight it there. That's the link. We've got the link. If anyone would like to go into that and do a 3-day trial, you're more than welcome to, and you can hear all of us and see the different styles of analysis we're doing. Right, I also see we've got a question from Ray Haas. Hello, Ray. You've got a correct... Oh, hi, Ray. That was a long time ago. Good to see you around and trading. That's lovely news. Do keep in touch, please. That's really fun. And then pan on fire, the lagging line is a tricky one. And what it is, it gives you, as well as today's level of support and resistance from the average and the clouds, okay? You look up and down vertically to try to find support and resistance levels. The lagging span, you do exactly the same, and it'll give you slightly different ones because you're looking at levels from 26 days ago, but they are valid for today. So they will give you additional levels of support and resistance. Perhaps if we work through some of the charts, it'll become clearer. All right? Oh, good. And I also hear from Michael that you're using the site, and I think it's good. So thank you very much for your kind words. It's really very welcome. I also have a question from Rianta. I'm not sure if I pronounced your name correctly. Are the moving averages simple or exponential? Simple, but using the average of the high and the low rather than closing prices. Simple moving averages plotted in the conventional Western way. So I hope. Now, you've got here another one. I've got Noga, who's got a question here. Is it 26 calendar days or 26 trading days? Very good question. I should have spelt this out. It is 26 trading days always. We ignore weekends now in technical analysis, both in Japan and in the West. Okay? Right. Well, I'll be honest with you. I tend to use daily charts, but my very active Japanese FX traders do go down to 10-minute charts. Okay? They do. Very active traders go down to 10-minute charts. I just suggest you try it out and see how you get on, how you feel, whether it's any good or not. Okie doke. So shall we work through a couple of examples? I thought we'd start with the euro dollar, because I'm sure that's the one you're all very super interested in. And if I can get this to shrink, and as no doubt you are only too aware, right, here we go. We have a very sharp sell-off when Mr. Bernanke told us told us that he was going to stop lightening the load, less money being thrown at us, which is very interesting because here, on this system, you would be long. The moving averages crossed to a long position on the euro-dollar exchange rate on the 6th of June. And notice also that we managed to break through what was a pretty skinny Ichimoku chart, and look how massive it had been, and look how it caps over there, also caps here, and then sends you down, and you be short here, and you switch round to long. I should add that this is a medium-term trending system. It is a medium term. Medium term, I would suggest it's a minimum of about 3 weeks, really. Okay, medium term trending system. So obviously in a market that's going sideways, it hasn't been doing very well at all for the euro. What I've drawn here is that you can see I've drawn a Fibonacci retracement from May's low to June's high, and we're exactly in the middle of it, and exactly on the 26-day moving average, which is providing support. I'd be looking for the combination today of the moving average and the Fibonacci retracement to try to support the euro today. If that doesn't work, I'd be looking for the 61% Fibonacci retracement and that rising cloud, to start providing decent support mid-July. So for the short term, I might just sit this one out a little bit, start providing support in July if the moving averages can remain like this. And we can go through quite a lot of sideways before they're going to cross, yeah, and start supporting later on during the month of July. Now I thought you might be interested in seeing also the dollar yen. Okay, and you can see that this one is more mixed, much more mixed, not so clear, in that the cloud, which had been rising, and the moving average, which had been rising, the moving averages have now switched to a short dollar, long yen position. I'm sure much to the chagrin of Mr. Kuroda. The candles are holding at the bottom of the cloud, and the cloud peaks in a couple of days' time and starts moving down. In other words, all aspects of this daily Ichimoku Cloud chart are suggesting you ought to be short US dollars, long Japanese yen. Today's break above the lower edge of the cloud and above this descending trend line that I have drawn in is absolutely capped perfectly by the 26-day moving average. Okay, so that, look how perfectly it is capped. My 9-day moving average comes in at 96.24. I'd expect us to drop towards it over the next couple of days, I don't know, maybe 2-3 days, and that would be my first area of support. My first area of resistance is, as well as that western trend line, the lower edge of the cloud. Today, which might turn out to be a doji candlestick, the 26 shooting star, I've been corrected, I'm sorry, which might, depends on where we close. The 26-day moving average is my next area of resistance, and the top of the cloud, which coincides with that previous upward trend line. Now let's look at the lagging span, okay? This is this pale green one. Look how it managed to get support from that skinny, horrid little cloud of 26 days ago and is now back above the cloud. Okay? So where does that have support? Well, my first support would be of the Ichimoku Cloud system will be there. Okay, so based on that, my first level of support comes in at about 95.75, and then the lower edge, which is that flat bottom there, which will be support for that lagging line, so long as it holds above that. Okay, and that comes in at 95.50. All right. First resistance comes in here for the lagging span, so quite a bit higher than we are now, but would be quite neat because it comes between that one and that one. Do you see? It's an extra level that you've got, an extra level of resistance that the lagging span has found that this one doesn't have. And then again, it's got an even higher level, higher than that top of the cloud. For the top of that, it comes in at 101. Okay, roughly 101. I've got a question here from Mrs. C. how can this 26-day moving average be so straight? I mean, it's horizontal. Yes, it is. It's quite extraordinary, isn't it, that it doesn't snake around like the shorter one does. I don't really know. I hadn't thought of that really, but it often is. I'll have to come back to you on that one. I'll do some more research and come back to you. I haven't got my textbook here at the office. I'll have to go back to my textbook. I'm sorry, Mrs. C. I can't answer that one. I also have another question from Nicole Elliott. I find sometimes that if you use the cloud and the CS to find support and resistance, I always end up with lots of support and resistance. Yes, you do. That is the nature of the game. Yeah, there's no ever one level that is key that will make your decisions easier. It's like, well, what if I go up to here and then stall? What if I go down to here and find support? You're constantly weighing up the variables and the probabilities associated with these to try to decide whether you want to be long, short, square, or just give up the will to live. Let's move on to another instrument that I thought possibly you might be interested in, the Nikkei index, which I think you probably have heard, having rallied phenomenally since November, has just given up a whole lot, almost half. Okay, it's given up almost half. I tend to use, you'll see here, Fibonacci retracements because this is what I've always used, okay, and then to that I added the cloud, all right? So number one are the candlesticks and the patterns associated with those. Western areas of analysis, which the Fibonacci retracements I love. Oh, by the way, I don't use Elliott Wave very much, despite my surname. It's not one of my favourites. But Fibonacci's I love. I absolutely love them. And what I've done here, you can see that the Nikkei gave up almost half of that rally ever so quickly. On this daily chart, you'll see. In a matter of about 5 weeks, we undid everything that it took us to construct with carefully guided interest rate policies. And now we've dropped below the bottom of the cloud. Look, the moving average got you short there. You're absolutely resolutely short this one. The lower edge of the Ichimoku Cloud is provided resistance today, on Friday, and all of last week. Look at that, look at that, look at that. Providing support here is the 9-day moving average, apologies. And notice also the 26-day moving average lines up with a 50% retracement of that. And then much higher still, we've got the top of the cloud at 14,800 and descending. Okay, so on this one, you certainly would not be looking to buy the Nikkei 225 Japanese index. Looking at another one I thought you might be interested, which is rather the sort of key to markets at the moment, is the yield on benchmark 10-year Treasury notes. Okay, these are US Treasury notes, and I think you'll agree we've backed up very, very sharply. Our sharpest back up that we've seen in yields, from 1.6% to 2.6%. In the space of 6 weeks or so. What is terribly interesting, we first started backing up on the 3rd of May, well before the 22nd of May, which is, I believe, this day here, when Mr. Bernanke first suggested that he would consider tapering within a few months. And if I take you up to a weekly chart, you will notice that we are very much higher than anything we've seen for nearly 2 years. Okay, we have retraced half of the drop in yields that we saw from the beginning of 2011 to the second quarter of 2012, and then you had this very, very slow backing and filling type pattern. We then broke above the top of the cloud moving averages, suggesting a long position early in May, and all of this suggesting a long position at the moment. Long yields, that is, short Treasury bonds. I would be very, very much more cautious here. Being the potential end to a very, very long move to lower yields that started in 1980, I would need sort of weekly, consecutive weekly and monthly closes to confirm this sort of move. So I'm keeping my powder dry on this one, particularly because the 30-year price action on the T-bonds, US T-bonds, does not agree with this. The price action on the gilts does not, English gilts, does not agree with this. And price action on Bunds and some other Eurozone debt does not agree with what's happening in the Treasuries. Yes, you might say the Treasuries are leading the way to higher rates. Yes, that is a possibility. Okay, and so we'll be doing that. And yes, I see, Laszlo, you'd like me to look at the DAX. I have the DAX prepared. How did I guess you'd all might be interested in that? I've also got the IBEX here prepared for you, but let me find the DAX first. Where have I got it? Oh no, it was on the other sheet. It was on my first sheet. Apologies. I've got so many charts that I thought you might be interested in. I've also got gold. I thought you might be interested in that one. I've lost the DAX. Well, let's look at gold quickly, and then I'll come back to the other one, okay? I thought you might be interested. This is spot gold, by the way, not COMEX futures. And I think you'll agree with me that this has been trading down since September 2012, first of all in a very neat trend channel. Then we completely slipped out of control because we'd broken not only below this trend channel, but below some important, very, very important chart levels on the weekly basis. I've drawn in a Fibonacci retracement of that complete catastrophe mess, and you can see we bounced, retraced 61% of that, double top, all the aspects of the cloud chart dropping down, still dropping down, absolutely relentlessly. This cloud is grinding you lower, absolutely grinding you down. What am I doing now? Notice how that lagging line got resistance, suffered from resistance from that moving average over there on the way down, and then the candles also from several days ago pushing you down, absolutely another nasty, nasty collapse. I'm now going to redraw my Fibonacci retracements taken from, taken from that recent low. With this very, very relentless move down, I really don't think we're going to get above 61%, which is $1,364 per ounce, and the cloud is also coming on down lower and lower and lower. On a weekly basis, here you have it. There's absolutely nothing whatsoever in this cloud that would suggest a long position over the medium term, and that was the level which we broke through. That was the level that caused this absolute collapse in very, very stale, long ETF positions that had to be bailed out at any cost whatsoever. So I'm afraid on this one, for all you gold bugs, I've got very, very little good news. Now let me try and find this DAX chart before it drives me insane, because I know I'd set it up for you. Here it is. Actually, no, that's the Bund future. Apologies, apologies. I'll try and find it in a minute. I'm not sure if I'm going to be able to do this. Maybe we'll just have to wait for another webinar. This is the one. This is the one that I've set up for you. This is the Bund future, and you can see the dreadful drop we've seen in May from almost a record high. I don't think that was record high at 147.2, 147. Yes, my colleague says it was a record high from the Bund future. That's right. So record high on the Bund future, 147.20, and now we've collapsed to just above 140. So that's 7 pfennig fall on something that's priced at 100 nominal, or a €7 fall on 147 nominal. Yeah. So that's a very, very big move. That's a really nasty move. It will, of course, hurt banks' balance sheets because they are one of the biggest holders of this stuff for their tier 1 capital ratios. Okay, and you can see that we've broken below a trend line. All aspects of this cloud chart, daily cloud chart, have been suggesting a short position since mid-May, since before Mr. Bernanke. Notice how that lagging line got absolutely smacked down, by that cloud of 26 days ago. That's that point there. Absolutely, categorically, smack down, broken below trendline support. And if I take you up to a weekly level, you can see why I'm saying that the Bund future does not back up what's happening in the Treasury notes. Yeah? As the yield goes up, the price comes down. Yes, the price has come down, but only back towards this horizontal line that had provided resistance in the third quarter of 2011, which is when, if I am correct, Mr. Draghi said he would put everything, do anything, whatever it takes to keep the Eurozone together, which is what lifted us up to this new price range, yeah, between 140 and 147. You do, of course, have a potential top there at 147 because we had been up there in the second quarter of 2012 and now we're up here again. And so, you know, it is a problem, all right? It might be a problem, it could be a problem. But at the moment, though we've broken below the bottom of the weekly cloud, my moving averages have not quite crossed. Look, they're exactly the same level, 143.8 euros per 100 nominal. That's the price of the Bund future at the moment, the moving averages, okay? And because it's such a big long-term move, I would be very, very cautious indeed. Now, I see we've got some more questions. Right, I see we're going to go back to the gold chart if I can find it. Let's have a look. My gold chart was on the other sequence, I think. Let's have a look. Right, here we have it. You'd like to know how I'm drawing my Fibonacci retracements. Let's have a look. Yeah, super question, Michael, again. Right, this is where judgment and your views will come in, and it's linked to your time horizon, of course, yeah? But basically, you must choose what you believe to be the latest significant high in a bear market. And obviously, in a bull market, you must choose the latest significant low point. And to that, you'll link it to the recent high or low. So this one, I have decided that is no longer the most significant recent high or low. It is probably going to be that one, and undoubtedly the significant low was Friday's low, okay, which is that one there. So I've linked that one to that one. But of course, this is where judgment comes in, and other people have completely different levels and different time horizons. I mean, somebody who maybe is happy to sit on gold for the best part of a decade probably will still be using something like that for their Fibonacci, okay? Something like that. They'll say, no, you know, I'm all right, whatever, you know? So this is where time horizons and pain thresholds come to play, yeah. Now, I think I've almost run out of my allotted quota on FX Street. Have we got any more questions? Yes, we have one from Gavin Schubert. What is the maximum time horizon you would suggest for drawing a fib retracement? Well, as I say, it's to do with what your time horizon as an investor is. I'll be honest here with you, an awful lot of my pension fund is currently allocated to top quality fixed income products. And the chances are that I'm likely to hold on to those, assuming we don't go into meltdown in the German Bund market or the gilt market. I can see myself holding those for maybe another 2 years plus. Okay, so with that in mind, you know, I'm quite relaxed. I'm not relaxed about the recent moves. I am watching them warily, but I don't think the price action that we've seen during the months of May and June are game changers. I think for commodities we have seen a game change. So not only the price of gold, that you'll see I've did an update today on the price of copper. I think that is due for a major, major game change, and therefore will affect the price of mining companies. It'll affect their viability, not only at the price at which they can sell their metals, but if you've been aware, a lot of these, there's been a lot of mergers and acquisitions, major, mega mergers and acquisitions among some of the biggest of these companies in the world. And these are very costly exercises because so much money is involved. And unless the money is there for free, the whole concept might be unviable. So think of that angle, as well as just, having a little go in the precious metals. It will affect all sorts of different things. Last question now, again from Noga Confino. Can you go over the 26-day calculation and how it affects today's price? Yeah, we'll do that again. This is not a calculation. This green line is merely today's closing price plotted 26 days ago. That's all. It is not a calculation. It's just the closing price. So you can see where I am now at $1,283 is that. Friday's closing price just below there is that. Okay, and then we had the closing price on the day before that, which is up here at 1,300 and whatever it was, is up here. And then that closing price is here. That's all it is. And what I'm doing here is looking at different features of my chart and saying, right, as at this day of business, I've got resistance from the averages, resistance from the cloud. Okay? This level here also had resistance, not from the averages, but not until way up till that candlestick. So it was much higher up, and the averages were much higher up. So the resistance levels were much further away. Okay? That's just the way it was on that day. Here you had much more problems. It was much closer, but this line would have had resistance from the candles and that moving average much closer than what you would have imagined from that cloud, which was higher up on that day. So here, the resistance levels on here, right, which is those days there, okay, that was much closer and much more useful for you. Okay, they were closer and therefore more useful to you than the cloud was on that day over then. Okay, I hope that explains.
Which index? Copper. Sorry, what is the index you talked about?
The index I did was, the index is the Nikkei 225, the Japanese main market stock index traded on the Tokyo Stock Exchange. It's called the Nikkei 225. It's the key Japanese index, and I thought you would be interested in that possibly because, the Japanese have this whole different question of quantitative and qualitative easing that they're pursuing at the moment. So basically we've got a sort of a boxing fight, haven't we, between Mr. Bernanke on one side, who says, no, I'm stopping the party, the punch bowl is being withdrawn, you have borrowed too much money. And on the other corner, you've got Mr. Kuroda, who says, no, I think this quantitative easing is a fantastic idea. In fact, it's so fantastic, I'm going to give you 3 times as much as you've had of it over the last 15 years plus. Okay? So that's the kind of economic fight, if you can picture that. And so there are your key markets, yeah? The Bunds, the Treasuries, the DAX. Let me see if I can get that DAX for you. I'm sure you're wanting to know where the DAX is. Let's see if I can just open it. Let me just see if I can find the right, here's my drive. Look, you can see how I've stored up all my different things and alphabetically listed. DAX. Ta-da! Wunderbar. Here, you've got my live analysis. This is exactly how I'm doing it, okay? Here, straight from the horse's mouth. I haven't even prepared it for you. Well, that Fibonacci is no good to man nor beast anymore, is it? That's a weekly chart. And what you can see, that what we're doing today is testing that weekly trendline support. My moving averages have not quite crossed to a sell yet. The red line here is a 9-week moving average. The black one is a 26-week moving average. And the cloud is pointing higher. Okay? So while we've seen a sell-off in the DAX index, we are supported by the Western trend line, by the fact that the moving averages have not as yet crossed to a short position, and by a rising, steeply rising Ichimoku Cloud. Now, if I take you down to a daily basis, I'm afraid the picture is not quite so rosy, is it? Just like in so many other markets, this one started from a much longer term low, September 2011. And while the weekly cloud has done a splendid job, and the moving averages have done a fantastic job with the index, I'm afraid it's not so rosy now, and that what we've seen is the moving averages crossed quite quickly. Note how quickly they flipped over here. Already at the very beginning of June, the moving averages have crossed to a short position, an absolute catastrophe, gapping down through a relatively narrow cloud in just one day, and now we're below it. So all aspects of this chart suggest a short position. Notice also how that lagging span on that day there was absolutely slapped back down by resistance from those clouds, crashing through the moving averages, and a super skinny little cloud that did nothing to stop the rot. What has stopped so far today is that Western trend line. Let's see. Obviously, if that one goes, that will be another nail in the coffin of this index, which is going to have to get used to the idea. From a Western perspective, we've got more support from that horizontal line. Yeah, I've joined the high of the second quarter of 2011 through to the third quarter of 2012. That might provide a bit of support, and certainly that weekly cloud ought to provide some support. So that's your DAX index. I hope it was worth looking at, and I hope you're all happy. Do they use clouds? I doubt it. I doubt it. They're fixed. They're firmly rooted, firmly anchored in economic traditions. What I can say, though, from posting my work on Bloomberg terminals for the best part of 15 years, Bloomberg provides me reports with who individuals and which financial institutions are looking at my technical analysis, and all my views are always based on technical analysis. And I can tell you that a massive, vast range of different organizations read my work on foreign exchange, on fixed income products, on money market products, as well as viewing me on television, CNBC and so on, and Reuters. But what I can say is that the IMF read my work, the Bank of England reads my work, the Federal Reserve Bank of New York reads my work, the Californian State Pension Company, CalPERS, reads my work, the Governor of the Bank of Ireland reads my work, the Greek Central Bank reads my work, the Bundesbank, I don't know about the ECB, I can't remember, I can't swear to that one, and just thousands and thousands of different institutions. And I think you have been very, very lucky over the years that FX Street has posted my stuff so generously and hosts it on their website. I think you have had access to the sort of research that some of these top people who believe they are in charge are getting used to. Right. I have a question here about something called MT4. I'm not aware of it. Okay, I don't use that myself. I have only ever, my charting package of choice has always been Reuters. That's my first choice, partly because their foreign exchange feeds are superior to those of other, because it's not just how good your package is, but how good is your data. Yeah? Think of that. Is your data clean? Is it consistent? Is it pulling from the best sources of that data? This is particularly important in over-the-counter markets, agreed? Particularly options and things like that, where if you've got only sporadic and spasmodic data feeds, well, from then on the charting goes downhill, doesn't it? So really you want the very cleanest, most consistent data. And I have spent hours and hours of housekeeping, making sure that my database is as clean as it possibly can be. You know, have a look, see if you like this one. You can try it for free, give it a bash and see what you think and how that compares to the other feeds that you're currently using. That would be my suggestion. Right. We have, as I say, we are a new small company, a small minnow here in this vast space. But we have already prepared a whole series of different educational videos where we're going to take you step by step through a series of different types of analysis, methods, patterns, oscillators, things like that. So do keep an eye out because I do think that with time you'll get far more confident in your trading. Right, well that's the end of our webinar today. I hope it has been useful and you've all enjoyed it. Thank you very much for participating.